Fundamental versus technical analysis. So what is fundamental analysis? It is the study of shifts in trends that are caused by external conditions. So some external conditions are news releases, weather, seasonal cycles, government action, supply and demand. So a fundamental trader will spend days reading newspapers, company reports, weather reports, company financial statements, import-export reports, and the list goes on and on. So the problem with fundamental trading is that you can never know enough about the stock or commodity that you're trading. By the time you hear the major news events or trends, the market has already moved. So if you've ever received some sort of news or stock tip, and if you've lost money, it is because the market has already moved. So that means that by the time you enter into the market, people are already selling, taking profit. So the solution to this problem is with technical analysis. Technical analysis is the study of price and chart patterns that causes shifts in trends that take into account all movement from fundamental factors. So the key is this. If you've received some sort of stock news or stock tip, you want to confirm the results with the technical analysis tools that we're going to show you. So if both the news and the technical analysis tools agree, then you can be confident to open a position. If, on the other hand, technical analysis disagrees with the news, then you would want to stay away from it. So can you think of some real-life examples where we use technical information to predict patterns? So with technical analysis, we are going to use indicators, technical information, and patterns to predict future activity. So this is similar to predicting the weather. So say that you see the dark clouds rolling in, and you see lightning, and you hear thunder, then you can predict that there will be a good chance that it is going to rain. So the dark clouds, the lightning, and the thunder, they all act as indicators telling us that it is going to rain. Another real-life example of where we use patterns to predict future activity is in predicting the tide tables. So say that we want to know what the tides would be like in the Gulf Coast region or on the Florida Keys, say on May 6, 2008. So what the analysts would do is they would look at the past to see what the tides were like on May 6, 2007, or on May 6, 2006. They would use that information, make minor adjustments to predict future activity. Another example of where we can use indicators to predict future activity is that we can predict which store has the best deals on clothes. So let me give you an example. Say that you wanted to know which store in the shopping mall had the best deals on clothes. A fundamental trader will spend hours visiting each store to record down the prices for each article of clothing. A technical trader will look for the store that has the longest lineup and visit that store first. The people lining up is an indicator that the store has the best deals on clothes. So similar to the above real-life examples that we've just shown you, when we are trading with technical analysis, we are looking for indicators and patterns that will allow us to predict the future activity of prices. So we look for volume, we look for money flow, we look at chart patterns, we have candlestick analysis, and these are all indicators that will allow us to predict the future activity of prices.